Oracle Corporation, NYSE ORCL, is currently trading at 178.98 USD, marking a sharp intraday decline of 9.65 points, or 5.12%, as the market processes a sudden shift in sentiment regarding infrastructure spending. While most investors are fixated on the headline drop, the real story lies in the massive divergence between Oracle's staggering $523 billion backlog and the immediate liquidity drain required to fulfill it. The market is effectively penalizing Oracle for its own ambition, fearing that the sheer scale of its capital expenditure, now projected to hit roughly $50 billion for the fiscal year, is stretching the balance sheet thinner than the enterprise software giant can comfortably sustain. This creates a fascinating tension between the expectation of a cloud-dominant future and the reality of a massive, dead-heavy construction phase that is currently weighing down the stock price. Many retail investors using a Robinhood app or various investing sites might see this as a simple correction, but institutional desks are looking closely at the exit of partners from major data center projects, such as recent reports involving a $10 billion facility in Michigan. When we look at the broader landscape of online investing, the prevailing narrative for months was that Oracle had successfully transitioned from a legacy database provider to a top-tier cloud contender. However, the reality hitting the tape today suggests that the transition is becoming increasingly expensive. For those engaged in self-investing through an individual brokerage, the volatility in Oracle stock today serves as a reminder that even the most established tech giants are not immune to the cooling of the artificial intelligence hype. While NVIDIA stock remains the darling of the hardware world, companies like Oracle are the ones having to pay the bill for those chips, and those bills are coming due faster than the revenue from their cloud instances can offset them. This creates a curiosity loop for the patient investor. If the demand is so high that the backlog is over $500 billion, why is the stock price cratering? The answer lies in the timing of revenue recognition versus the immediacy of cash outflows. Common ground in the market right now is the belief that cloud computing is a safe bet, especially with the expansion of the Oracle Cloud Infrastructure, or OCI. You will see this reflected in many Schwab Intelligent Portfolios or Fidelity Wealth Management strategies that favor diversified tech exposure. But the contrarian take here is that Oracle is currently caught in a capital expenditure trap. They are forced to spend at hyperscale levels to compete with Microsoft and Google, yet they lack the massive consumer-driven cash cows that their rivals possess. This forces a reliance on the debt markets, which is exactly why credit default swaps for Oracle have seen such a notable spike recently. It is a high-stakes gamble on the future of enterprise compute. If you are watching this and wondering how this fits into your own portfolio, comment below how many shares of Oracle Corp you currently hold, or if you are waiting for a deeper dip before you commit your capital. Recent stock movement has been characterized by high-volume selling, often exceeding 30 million shares in a single session, which indicates that large institutional players are rebalancing their tech weightings. We are seeing a ripple effect across the sector, where the initial excitement over AI-driven earnings is being replaced by a sober assessment of the cost of that growth. While the Apple stock performance, or the latest movements in Tesla stock, often grab the headlines, the enterprise backbone provided by Oracle is perhaps a more accurate barometer for actual corporate AI adoption. The reality is that while cloud infrastructure revenue grew by roughly 66% in recent reports, the traditional license business is showing signs of fatigue. This suggests that Oracle is cannibalizing its own high-margin legacy business to fuel its lower-margin, capital-intensive cloud expansion. For anyone using Interactive Brokers trading or a Robinhood stock trading account, the technical levels are becoming critical. We are seeing Oracle trade well below its recent 52-week highs, and the 200-day moving average is becoming a focal point for technical analysts. The tension between the bulls who point to the multi-cloud partnerships with Microsoft and Google and the bears who point to the rising debt load is at an all-time high. Fidelity Investments and other major firms like BlackRock or Vanguard remain significant holders, but even they are likely scrutinizing the $15 billion increase in capital expenditure expectations for 2026. This isn't just a minor adjustment, it is a fundamental shift in how the company prioritizes its liquidity. To understand where Oracle is going, we have to look at what they actually do today. They provide the literal plumbing for the world's most critical data. From healthcare systems using Oracle Health to streamline patient records to global logistics firms running on Fusion Cloud ERP, Oracle is deeply embedded in the global economy. Their business model has shifted toward a subscription-based approach, which provides more predictable cash flow, but the cost to build the data centers to house these subscriptions is where the friction lies. In the past, Oracle could rely on high-margin software updates. Now they are in a race to build physical AI factories using the latest hardware, often discussed in tandem with the latest updates from NVIDIA stock. This shift has changed their profile from a high-margin software firm to something closer to a high-growth utility company. Looking ahead, the future outlook for Oracle depends on their ability to convert that massive backlog into actual operating income. Potential catalysts include the wider availability of the Oracle database at Google Cloud and the continued deployment of GPU clusters. However, the risks are equally significant. If macroeconomic pressures lead to a slowdown in corporate IT spending, that $500 billion backlog might not materialize as quickly as the market expects. We are also seeing competition from specialized firms and the ongoing dominance of AWS and Azure, which makes Oracle's path to market expansion quite narrow. For those seeking investment help or looking for the best investing sites, it's important to distinguish between a company's product success and its stock's financial health. Oracle's products are arguably better than they have ever been, with their autonomous database and sovereign cloud offerings gaining real traction in regulated industries. But for the individual brokerage owner, the stock price is a reflection of the cost of that success. The current market reality is one of skepticism regarding the return on investment for high-end AI hardware. While the intelligent portfolio of the future will likely include enterprise AI, the question is how much the current price already accounts for that growth. Fidelity brokerage users and those monitoring their Fidelity IRAs will note that Oracle has historically been a reliable dividend payer, providing a yield that offers some cushion during downturns. But when a stock drops 5% in a single day, a 1% dividend yield does little to soothe the sting. The intraday movement we are seeing now is a clear signal that the market is demanding more than just growth stories. It wants to see a path to sustainable free cash flow that isn't entirely consumed by data center construction. The expansion into regional data centers and sovereign cloud is a smart move to capture government contracts, but those are notoriously long lead time projects. If you are managing your own portfolio through SoFi Investing or the Robinhood app device, you have to decide if you believe in the take or pay contract that Oracle is utilizing. These contracts are designed to ensure revenue, but they also require the company to have the infrastructure ready at a moment's notice. This is why the spending is so aggressive. They cannot afford to have a customer ready to move to OCI and not have the rack space available. This is a classic build it and they will come strategy, but it is being executed on a scale that few companies in history have ever attempted. In the world of online investment, transparency is often lacking, but the numbers here are quite clear. Oracle is betting the entire house on becoming the premier cloud provider for the AI age. They are moving away from being a software company and toward being a total infrastructure provider. This transition is messy, it's expensive, and it is currently being tested by a market that is losing its patience with the high costs of artificial intelligence. The contrast between the expectation of a seamless transition to the cloud and the reality of the massive capital requirements is what is driving the current price action. As we summarize the situation, the central insight is that Oracle is currently a victim of its own success. The demand for its services is so high that it is forcing the company to spend capital at a rate that unnerves the traditional investor. The reality of $50 billion in capital expenditure has overshadowed the expectation of high-margin cloud growth for the moment. For anyone looking at Fidelity ETFs or Fidelity mutual funds that hold large positions in Oracle, the coming quarters will be a test of management's ability to balance this growth with fiscal discipline. The stock is currently in a period of price discovery, trying to find a floor after the recent earnings-induced sell-off and subsequent rumors about data center partnership shifts. Whether you are using a SoFi trading platform, Interactive Brokers fees analysis, or looking at investment sites for the latest tips, keep an eye on the interest expense. As Oracle takes on more debt to fund its cloud expansion, the cost of servicing that debt in a higher-for-longer interest rate environment will become a larger drag on the bottom line. This is a factor that many investors overlook when they are focused solely on revenue growth. The total cloud growth rate might be 40% or even 50%,